Welcome to Protea Academy. My name is Zane Stevens. I'm the founder of Protea Financial. At Protea Financial, we understand that strong financial foundation is essential for successful businesses. One of the most important tools for assessing the health of your business is the balance sheet. This document provides a snapshot of your business's financial position at an exact point in time, and it outlines the company's assets, liabilities, and equity you may have. Our goal is to help you break down these key components and explain why they matter for your business's success. So let's start by understanding the balance sheet. Understand that the balance sheet is a snapshot in time of the financial position of your business. The balance sheet adheres to the fundamental accounting equations, which is assets equal liabilities plus equity. This equation reveals how your business's assets are financed, whether through debt or through owner's investment. We often find business focused on daily operations sometimes overlook the importance of regularly reviewing their balance sheet. However, this document provides valuable insight into your financial stability and potential growth. Assets. What your business owns. Assets represent everything you own that has a monetary value. They are characterized into current assets and non-current assets. Current assets, these are assets that can be converted into cash within 1 year. For a business, this typically includes cash and cash equivalents, accounts receivable, which represents money owed to you by customers, inventory, including any raw goods, working products, as well as finished goods, prepaid expenses. These are expenses that you've paid in advance. Think about annual subscriptions. Additionally, your business could have non-current assets. These are assets with a lifespan in excess of 1 year. For businesses, this normally includes property, plant, and equipment, which could include buildings, equipment to manufacture your product, vehicles, office furniture. Your non-current assets could also include intangible assets, which includes trademarks, patents, and goodwill. Understanding your business's assets allows you to assess your liquidity, operational capacity, and long-term investment potential. We've seen how many businesses that meticulously track their asset values make more informed decisions about expansion and resource allocation. Liabilities. Liabilities represent your business's financial obligation to external parties. They're also categorized into current and non-current, the same way that we do with assets. Current liabilities are liabilities where your obligation to pay them off are less than 1 year. For a business, this typically includes accounts payable, money owed to vendors for services or goods purchased, short-term loans that could include bank loans, line of credit, or even loans from investors. This could also include accrued expenses. These are expenses that incurred, not yet paid, such as salaries, utilities, etc., as well as current portion of long-term debt. Non-current liabilities are obligations due outside of 1 year period, and these typically include long-term loans like mortgages, as well as term loans with repayment periods exceeding 1 year. This could also include deferred tax liabilities. Manage your business liabilities effectively is crucial for maintaining financial stability. We often advise our clients to carefully monitor their debt levels and ensure they have sufficient cash flow to meet their obligations. Last up on the balance sheet is equity. This is your stake in the business. Equity, it reflects the residual interest in the assets after deducting liabilities. This generally includes money you put in, draws from the business, as well as any retained income or losses. Equity is a crucial indicator of strength and long-term viability. Why does the balance sheet matter? The balance sheet provides a comprehensive view of your business's financial health, allowing you to assess liquidity by analyzing your current assets and liabilities. You can determine your business's ability to meet short-term obligations. Evaluate solvency. By analyzing your total assets and liabilities, you can assess your winery's long-term financial stability. Track growth. By comparing balance sheets from different periods, you can track your growth and identify trends and understand if you need to inject more capital into your business. Make informed decisions. The balance sheet provides valuable information for making strategic decisions about investment, financing, and operations. Do not underestimate the importance of your balance sheet. When reviewing your financials, make sure you have time to review it and ask questions of your accountant. The balance sheet hides all the secrets of your business, gives you a clear indication of the financial health of your business. Learn to read the balance sheet.